gonna break them out into what I'm gonna break it out into what I call flippers. And these have been on TV now for the last 4 or 5 years. And they are buying properties, fixing them up and selling them. They're kind of hate to say it, but they're the kind of get rich quick. They're in it for that thrill. The second group you've got are the buy and hold. Those are the ones that own apartment communities, commercial buildings, single family residences. There might be a little overlap, but they are in it for the long play. They're not worried about where they're going to make $20,000 on a purchase and a flip. They're looking at this long term. They understand three or four things. They understand leverage, they understand interest rates, and monthly payment or amortization schedules. And they also understand depreciation. Depreciation is outside the scope of this conversation. So we're going to hold it to interest rates, amount of payment, and leverage. And so I'm going to break that group of buy and hold people up to about 2 or 3 different categories. You've got the young investors who are just getting started. Okay. They're probably in their 30s and 40s. They bought a couple of pieces of property and they're building their portfolio of real estate. Then you got a group of 45 to 60s who've owned the properties for some years. Now they've built up some equity in those properties. And then the last group of those over 60 that may already have all their property paid for and no more mortgages. And I say that because typically what a real estate investor does is if they have equity in a property, what do? They either refinance it and take out as much money as they can and go buy other properties, or they just keep refinancing and building up money on the side for the next big deal. But they always want to try to stay as leveraged as possible until you get to some point in time, and then you start saying, I'm not going to buy any more property, and you're not quite as leveraged. So that's what the real estate investor's thinking. Leverage, leverage, leverage. They're going to take the bank's money, borrow that, and earn more on it. The last 2 or 3 years was really good when interest rates were 4 or 5%. But today, the prime is 7.75. So they're borrowing it probably, depending on the credit worthiness of the client, somewhere between 7.75 plus 1 to 2 points. It's called prime plus. So most investors are going to be prime plus 1 to prime plus 2, depending again on the credit worthiness. So they're really not wanting to buy any properties right now. It's just too expensive for them. And we're going to talk about them because a lot of these people have floating rate notes that come due, and usually on a 5-year fixed period. So if they've done anything, they've got some higher rates coming up, and we'll talk about what that might occur to cause for them. But let's talk about how to approach them. So I'm going to describe, and I'm going to use Todd as my prospect. And I've already gotten in front of him. I have a relationship with Todd, and I want to describe the product that I want to talk to him about. So here we go. Todd, I heard about this product in a recent seminar, and when I heard about it, I automatically thought about you because you're a real estate investor. I think this is right up your alley. And what I've got is a product that the company will sell. They sell it in tranches of $1 million. Now with you, if you don't want to do $1 million, I can probably get the company to do a half unit for you and just do 500. Let's talk about doing $1 million. So here's what you do. Todd, you're going to pay 4% of that asset for the next 20 years. That's less than an interest-only loan that you got now, which is going to be in the range of 8 or 9, wherever it may be. So on that $1 million, you're only going to pay $40,000 a year for 20 years. Now, here's the good part about this. Here are the good features about this. You have no closing costs. You don't have to requalify or redo this every 5 years or whatever that fixed interest rate period is that you have. You got no property taxes to pay on this piece of property. Now, how many of you, Todd, how often do you go down and talk to the tax assessor haggling about the value of the property and property tax you're going to pay? That's pretty frequent, isn't it? Once a year, more than likely. And if you got 10 properties, they may be in 10 different counties and you got to go see 10 different tax assessors. This product, no property taxes. You don't have to buy any P&C insurance on it, any liability coverage on it. There's no management fee. You don't have to worry about vacancy. You don't have to worry about tenants calling you in the middle of the night saying, hey, my toilet's out. Can you get it fixed? The AC's out. So there is no maintenance on this product. So you're paying this $40,000 a year for 20 years. How those features sound to you, Todd?
Sounds great.
All right, let me tell you, but now you haven't really don't know what you're getting for that, other than having this $1 million asset, right? So I said you're going to do it for 20 years. Over 20 years, one of two things are going to happen. If we look now at March 1st of 2043, Todd, one of two things are going to happen. Either you're still going to be with us or you're not. If you're not with us, this company is going to take that asset, give it to your beneficiaries with plus all the contributions you made during that time, tax-free. I repeat that, tax-free. All right. So if you passed away in 15 years, you paid $600,000. The company's going to give you the $1 million asset plus your $600,000 of contributions for $1.6 million. Lump sum, no questions asked. That's really not what you want to happen though, is it, Todd? Don't you want to make it 20 years?
Yeah.
All right, let me tell you what happens at the end of 20 years if you make it. You've got three options at the end of 20 years. First, you can take your money and go home. Now, what you'll get is going to be tied to like a floating rate interest. It's tied to the S&P 500, so we don't know exactly what's going to happen over a 20-year period. But I'm going to show you an example in a minute. I assume you're 60 years old, Todd, and I'm going to show you what that number would be based on history over the next 20 years. Now, of course, we all know that past performance is no guarantee of future performance, but we can use it kind of as a guideline of where we might be 20 years from now. So that's one option. I think it's the worst option, but you can keep it. You just take your money and go home at the end of 20 years. You don't get the $1 million. You just get whatever this amount has grown to. It'll probably be about $1 million, but I can't say that with certainty. The second thing is you can say, Ralph, I'm going to just hold this thing. I'm now 80 years old. You know, I'm just going to hold this thing. And if I pass away at that point in time, my beneficiaries are going to get $1.8 million tax-free cash. Okay. That's your $1 million plus the 800 you paid. If you make it to 90, it's 1.8. If you make it to 95, it's 1.8 going to your heirs. Could probably even be outside your estate and avoid any estate tax liability if you do it properly. But let's say the third option is, let's say that you want to turn it into an income at age 80 when you get through this 20-year period. I can give you a tax-free income starting at age 80 if you'd like. Now that'll affect what your beneficiaries would ultimately receive out of the deal, but you can get that as tax-free income. How's that sound to you, Todd? You like that product?
It sounds great, Ralph, but who would do something like that? How does that work?
You know, they're small companies. They only got about $300 or $400 billion of assets. That's B with a billion, not M as million, but billion. That's a pretty good sized company, Todd. And they've been doing this for years. They've been doing this type of thing for years. Now, how would you like to know? Would you like to know more about it?
Absolutely, yeah.
All right, let me show you how that works. And by the way, Todd, you know what they're going to do? They're going to give you a life expectancy test. Do this to see if you qualify for a discount. So let me show you. I'm going to share my screen now, and if I can find it. You see that with the nationwide illustration?
We don't see it yet, Ralph. No,
You don't see it?
no.
Well,
Ah, there we go. There it is.
all right.
But then,
There you
yeah.
go. There we go. Now, if you've had any questions so far, as we go through this, write them down in the chat box and we'll address them in just a minute. But that's basically the presentation to get the client interested that there's something out there that they may or may not be aware of. We've yet to talk about life insurance. We've just described an asset in terms of not having any of the headaches he's got with his his or her real estate portfolio. You got, $1 million, which gets their attention because they're accustomed to buying large value products. So,
Ralph, we're seeing your Excel spreadsheet right now. I think,
you are?
yeah, I think
Yeah.
you wanted the other,
Okay.
yeah.
Let me stop that share and share screen and. How about that now?
There you go. That's
Okay.
nationwide, yeah.
Okay, sorry about that. Now, so here's what we talked about. I did this of a 60-year-old gentleman. And I'm sorry, ladies, but at this point, most real estate investors are guys. The women that kind of got to the table a little bit later, and you're not going to see many 60-year-old female investors unless it's an inheritance. Most of them that have gotten in the business are younger. But here you're paying the $40,000 of premium or contribution. The death benefit is the $1 million plus the sum of the premiums. So for example, in 5 years, they paid in $200,000, the death benefit's $1.2 million. If we go out here and I said it was a 20-year deal, put in $800,000, the death benefit's $1.8 million. And this is the number based on the past 50-year look back of what that would turn out to be is a little over $1 million in 20 years if they wanted to walk away from it. It's a standard indexed universal life product. The only thing we did is I put in a surrender charge waiver here so that there's no surrender charge in the event he terminates in the first 10 years. Now, so that is the way to describe that product. And I hope you listen to it with open minds to say, it's not about death benefit. It's not about cash value. It's about an asset. And oh, by the way, Todd, I forgot to mention this. Let's say that on one of your other properties, you had somebody fall down and break their neck and die, and they've sued you. And they've won a $10 million judgment against you, Todd. This asset's in the protected class. You could take your money, go, and they would not have access to it. That's another advantage to this life insurance product or this protected asset class. All right, so Todd, do we have any questions about this?
Just not specifically at the moment. Does anybody have any questions? Please put them in the chat box and I'll be happy to read those.
None?
I don't see anything yet, Ralph. Yeah, I'll let you know if something comes up.
All right. I'm going to try to show everybody. Now, by just a show of hands, how many of you have thought about presenting or talking about life insurance in this fashion? Is that different than what you've thought about it in the past? Okay. Remember, because the real estate investor understands leverage, understands interest rates, because they all believe they can borrow money and go out and earn more if they buy property. Now, a couple other things I want to talk about too that we mentioned briefly. is a lot of investors bought property 4 or 5 years ago when interest rates were low, 4 or 5%. They're now up to say 9%. So they come to a renewal, and typically these things run with a 20-year amortization and a 5-year fixed interest period. That's how a lot of people choose to do it. So when they come up at the end of that 5-year period, they're now looking at current interest rates going from 4%, what they had 5 years ago, to now 9%. That's going to make their mortgage payments go up about 40%. Not saying it's going to happen to a lot of them, but it will happen to some of them that they'll lose some properties because they can't make that further payment. So don't sell the protected asset class short to those people. I don't think that would be a question I would lead with in the conversation, but it is one that you should be asking is, tell me about your interest rate risk that you've got coming up for any refinances or renewal periods. And-
Ralph, Julian has a question. He asked, do you discuss overfunding as well?
No, I usually just choose the 4% number because this is pretty close to, I think this is pretty close to MEC on this one. I didn't
Yeah.
look at it, but I would assume it's fairly close.
Yeah,
No, it's not. It's the $99,000 MEC premium right there if you see it. So you could do that and you could put as much as $100,000 into this contract. Now make it sound more like the 9% loan that they would have to make at the bank. But remember, we're going to do a life expectancy test and see if you can get a discount.
right.
That's a good question. But go back, I think there might be some people who have a little bit of renewal rate interest risk that they might lose some properties, and they could put money into a life insurance contract today and protect that. And you say, well, you know, $40,000 a year, I don't know if they get a lot of money into it before they had a problem. Well, they could put as much as they wanted to. They could do this single premium amount, which is $538,000 into the contract. And you say, oh, Ralph, that'll make it a MEC. I'll tell you what, if somebody's worried about where they're going to lose some properties and go through foreclosure, worrying about the taxes on a MEC policy are the least of their concerns. They'd much rather shelter $500,000 of assets. So that's another thing that you could talk to them if, you know, again, that's not the one you want to lead about because it's not a very nice conversation to have with. The other thing that you might want to do, and it's a little bit beyond this, but we will be willing to talk about it to anybody, you know, individually, is we mentioned that they like leverage. They love to leverage as much as they can. Banks will only loan 70, 80, 85% of the value of a piece of property. Okay, depending on the credit worthiness, you might get 85. So they got 15% of money tied up in that property. If the property's appreciated, it's more than 15%. They can't refinance it right now because nobody wants to refinance a piece of property in today's interest rate scenarios. So you could actually use the equity that a bank won't loan them to do premium finance and get money into a life insurance contract and leverage up that 15% of equity they've got in their properties. Again, outside the scope of our conversation today, but just wanted to bring that to your attention. So if there are not any other questions, I'm going to go to the second part that we wanted to talk about today. All right, any more questions, Todd?
No, no more at the moment. So go ahead.
All right, now do you see my Excel spreadsheet?
I still see the Nationwide. Okay.
Let me go back and share again. How about now?
All right, now you're good. Thank you.
Okay. Now, what I want to talk about is positioning life insurance as an asset class in somebody's portfolio. We're all familiar with diversification and that topic, right? Well, but we really don't think of life insurance as an asset. It's somewhere else out the side. It's a protection of. Well, I want to bring that home, how it can be used as an asset class. And there's something out there, there's a theory called sequence of returns. And the interest rate that you earn each and every year makes a difference on what you'll have at retirement age. And I'm going to illustrate that for you, how it works and what that means. So I've gone and loaded up all the S&P 500 annual returns from 1926 to 2023, I think it is. So if we take this 45-year-old and we do $25,000 of contribution, I'm just going to start with the S&P in 1945 and go through 1964. And these were the rates of return. Started out at 30%, a good number. Next year it was minus 12. And then the last year it was about 13%. So if this person put in $25,000 a year, at the end of 20 years, it's worth almost $1.6 million. Does everybody see that?
Yes.
All right. Now, what happens if they started putting aside money in 1953 instead of 1945? That $1.5 million or $1.6 million is now only $1 million, $1.05 million. That's what the sequence of returns difference makes. And you say those are old years. Okay, let's go to 1994. I'll just pick a number. 1994, you only get $960,000. You pick 2002. Again, I don't know. I'm just putting in these numbers. I haven't even looked at them really. Well, 02, it's $1.6 million. Sorry about that. It's $1.6 million. So the point is that it changes depending on what's going to happen over the next 20 years because we don't know. And those are fairly significant fluctuations over a 20-year period. From 960,000 we looked at one year to 2,000,002. I'm sorry, what was 960 to 1611. It's a big difference. So we say, okay, let's say we talk about putting life insurance in there as an asset or a hedge to develop a diversified retirement income strategy. So if we go back to 1953, and they're going to put in $25,000. Okay, let's say we put in $15,000 into the investment account and $10,000 into the life insurance policy. At the end of 20 years, that $15,000 would have grown in the investment account to $630,000. The life insurance cash value would have been $357,000 or $987,000. If I take the numbers from the previous screen, it was $1.05 million. So you're a little bit behind if you'd have just invested solely in the investment in the stock market. Okay. Now, if we start taking out income for retirement, sorry, but my mouse is a problem. If we start taking out about $42,000 a year, just out of the investment account, it would have run out by age 80. And then you'd start taking $35,000 out of the life insurance contract through age 90. And you still have $560,000 left. Okay. Conversely, if we look over here, if we sum those together, at age 75, we'd have had $666,000 between the investment account and the life insurance cash value. If you'd been solely in an investment account, you'd have been $665,000. Does everybody see that? Does everybody understand that? If you split the $25,000 of investments and started taking money at 65, you'd basically be in the same place at 75 had you bought a life insurance policy. But here's where it becomes powerful. let's say that we're gonna only take out money out of the investment account the year after we've had a positive return. Because you don't want to take out money when it had a negative return, do you? Because if you take out $1, it's really costing you $1.20 to take it out of your investment account. So let's just what we call diversify that with the life insurance. So now you see that year was positive, so we took the $41,000 out of the investment account. The next year it was negative, so we took the money out of the insurance policy. Is everybody following that?
Yes, Ralph, pause for 1 second. If everyone would please mute yourself. I can't do it from here, so please go ahead and mute yourself because we're hearing some background noise. Sorry about that, Ralph. Go ahead.
Okay, so now let's look at you still would have had $665,000 in your investment account, but now if you use this retirement strategy, you're gonna have $737,000 between the investment account and the cash value. That's about 10% more. Okay, if you go to age 80, you're back about even because there were good years in the stock market, so it grew fast. And you can see how the effect of the interest rates of 34, 20, and 31 in those 3 years really made the investment account take off. Can't guarantee that won't happen. Can't guarantee that will happen. But if you have this investment strategy, it will help you isolate or insulate your retirement income from the ups and downs of the stock market. And with what we've seen over the last year, 18 months, there are a lot of people that want to talk about this, but they need to start buying life insurance to grow that tax-free deferred growth, tax-deferred growth of the life insurance contract today. It's hard to wait till you're 62 and try to make that for retirement income.
Mhm.
So again, I did this at a 15% tax bracket. Does anybody think they'll be in a 15% tax bracket at retirement? Let's see what happens if you do it at a 20% tax bracket. Now, at 75, you would have only had $629,000 in your investment account and $716,000 in the life insurance and investment, the pair. At age 80, you're back about even. Okay, but again, I don't think it's 20%. I think it's going to be when you add your state income tax. What if it's 30%? Now look what happens. Oh, you know, I don't have that. I don't have 30% of the tax break in there. Take that back. Let's go back to 20. At 20, it's still giving advantage to the life insurance. You say, Ralph, you just picked out 1 year. Let's what happens in another year. So let's go back and not diversify and let's choose 1945. Now, the reason I'm having to go back so far is because we're looking at something projected out 45 or 50 years. So I got to have enough history to make this work. So now if we go back to 1945 and we go back to the original strategy of just taking money out of the investment account till it runs out and then start the insurance to come out. When we get to age 75, we're pretty close, within $15,000. If you go to age 80, we're starting to fall behind, and we fall further behind at age 85. Okay. If we do the diversification strategy we're talking about, now we get much closer to the, call it with the investment account. It's still not there, but I hope you see how this prolongs your money if you can draw from a account that's not strictly correlated to the investment of the stock market. Because the stock market has ups and downs. You don't want to take money out of the market in down markets. So if you have this strategy where you have something that's not tied strictly to the ups and downs of the market, then you're going to do much better in getting income out when you get to be 65 or 70. Again, this is illustrative purposes only, but you can go back here and see what that sequence of returns does to you. Again, I'll just put a different number in there. This was $1.8 million. Unfortunately, I can't compare that here because it takes about 10 to 15 minutes to run each year and each age to get this formula. So I've only got 2 years that I put in here, 1945 and 1953. I did 1953 from the insurance companies do that because that actually is the one that works best. I think that where they have the 50-year history. Now, I know those are a lot of numbers, but I'm a numbers guy, good or bad. But again, what I want you to take away here, 2 things. That if you're going to develop a retirement income strategy, most people are thinking about what's going to happen between now and retirement age, but you really need to be thinking about what's going to happen after retirement. How are those fluctuations in returns going to make a difference to you? So that's what you got to think about. And then the second thing is that this diversification strategy that you can apply, but you got to start now. You can't start at 62. You got to start in your younger years to have this strategy to be able to take money out of the insurance product when you get out there and have down years in the stock market. So you're only taking out dollar for dollar. You're not taking out $1 and it's costing you $1.20, $1.30. Because one other thing is if you have $1 and the market goes down 20%, you now got 80 cents left. You got to have a 25% return on that 80 cents to get back to your dollar. Not so if you use and insulate that with life insurance.
Ralph, I would add to that, most people don't really have a retirement distribution strategy until the day after they retire. But knowing in advance that you have a track that you can follow from retirement to the end of your life would be extremely comforting, I think, to a lot of people. It would allow the whole idea of retiring to be a much less stressful process, and knowing again a way to follow your distributions and to track your distributions in retirement.
Yeah, I think you make a good point, Todd, because a lot of people are thinking about what they're trying to do is get to 65 with the biggest basket of money.
Right.
And that's really not what you're trying to do. You're trying to get to 65 so that when you get beyond 65, you can have the greatest amount of income with the least amount of stress. Because as you get older, the investment returns, you're not going to have a 72-year-old who wants to have 100% of their money invested in the S&P 500. That's going to be too risky for them. So think about this now, and then this gives you some comfort that when they get to be 72, if they have this strategy in place, maybe they can have a higher percentage of their assets in a S&P 500. But this talks about why you need life insurance, and it shows graphically in numbers to somebody who's hesitant to take $1,000 a month and put it into a life insurance contract. You can now back it up with numbers. I said, I can show this to you. I mean, if you have somebody and you want to see some different years and a particular client, let us know and we can put this together for you. It's like I said, I just can't make every combination of, the last 50 years in my spreadsheet. I had to do it 1 year or 2 years at a time. So again, I will stop there and let's see if there are any questions that anyone has about either of these topics.
Yeah, I think at this point you can unmute yourself and just verbally ask the question if you'd like. Jack Cunningham asks, is it possible to get a copy of the spreadsheet?
Jack, I can get that to you. Let me put some disclaimers on it because this is certainly not, I don't know if you're securities licensed, but it's certainly not compliant for broker dealers and securities reps, but I can put some disclaimers on there and get it out to you.
So it's not compliant for securities reps? Is that what you're saying?
Not, no, because most compliance departments that I've dealt with want to review everything you put out there. But you know, if you put some disclaimers, and this is really not a securities product, you're talking about life insurance. All you're doing is putting numbers together. So you're not trying to sell. Now, if you were trying to sell a variable universal life with this concept, then it would be subject to your broker dealer compliance. But you know,
Yeah.
I'd rather err
I
on the
agree.
side of caution than put something out there and have having FINRA knock on my door and say, "What is this you've been putting out there?" So I'll put the disclaimers on there that, you know, past performance is not a guarantee of future performance. These are projections, et cetera, really to get that out there that you see on just about everything today.
Okay, that'd be great. Thanks.
Ralph, Julian asked, do you ever use VUL with real estate investors?
I do. It just depends again on the particular investor. When we're talking about the buy and hold investors, it sounds crazy, but they're actually a little bit more conservative than some of the more aggressive investors you'd see in the market. They don't really think a lot of times of the real estate as being a very risky investment, even though it can be. So it depends a little bit on the personality, and you would have to explain to them the one problem you got with the real estate or the variable universal life. If we go back to these S&P returns, and I'll show them to you. You know, here they are. In 1990, it was -6. 1991, it was 26. So you got a lot of wild fluctuations when you really are in the VUL market. Whereas if you use the IUL and you zero out the negatives and cap these positives, you get a return similar to the S&P 500, but you don't have the great fluctuations that you see. So for a more conservative investor, I would do that. But yeah, VUL, you can work. Again, you just got to be sure the client understands the risk they're undertaking.
Yeah. Ralph, Calvin asks, what are your thoughts about whole life?
Again, whole life, if you're talking to a real estate investor and you talk whole life versus IUL, this would be, I think, what you get from them. With whole life, they're thinking of that is akin to a bond return. All right. The IUL has something tied to the S&P 500, which means there's a little bit of risk involved, but it's not as risky as putting all your money into, you know, a startup or a growth fund.
Right.
So I think they will tell you that the whole life is going to be too conservative for them, that they can certainly earn more money with their money than they can in a whole life product, but they have the ability to gain something in the IUL. Again, it goes back to the client. I'd never say one product is the best fit for anybody. It all depends on that client's tolerance risk. Some like whole life and would not have anything to do with IUL or VUL. Some, all they want is risk. That probably would fit the flippers we talked about earlier. They're much more of a go personality, and that would fit them. And then you got, you know, a 60-year-old who's been around for a while, and they don't want the bond return of a whole life. They want something that, and the term is, you may have heard this, zero is your hero, which is what the IUL is, that they're not going to get any zero, they're not going to get any negative returns. They're only going to get zero or positive, and they're willing to give up a little of the top for security on the bottom.
Yeah.
So again, it just kind of depends on who you're talking to.
Yeah. Ralph, Julian asked further question, walk through how to use premium financing. Don't you need to allow some liquidity in case and collateralize the properties?
Well, the property owner is going to say no. He wants to be leveraged 95% or 100% if he can be, because he just counts that equity in a property as stale money, is wasted money. So that's one of the things you want to do. A premium finance would possibly free up some of that to be put into an IUL, where he's now that return, not only is he getting the return in his property, his real estate, but now he's got the opportunity to earn even more by leveraging it in an IUL.
Right.
Again, there's when the higher the leverage, and they understand this, the higher the leverage, the more risk there is. I'm not saying they're going to shy away from it, because
Well,
on my property, if I could leverage 100%, I'd do it. But you also have to be in a situation where if things turn and go south and the market starts going south, you can deleverage yourself. And that's one of the things with a life insurance contract. You can, get rid of most of that. Not all of it, get rid of most of it.
And I would add, with more generically speaking, not necessarily real estate investor, but with a good candidate for premium finance, part of the argument is that you're leveraging everything to allow you to keep your own money to put back into whatever business you're in. So it frees up that money for you. You're growing while you're growing through the policy, as well as adding money back into your own business.
Yeah, most of these real estate investors are paper rich and cash poor. They don't like cash sitting around. They get nervous. They get a lot of cash sitting around. Again, these are just generalities. You'll find an exception to all these things I'm telling you. But the main thing is they don't like cash sitting around, and they want to be leveraged at the maximum amount possible. Again, in today's interest rates, they've not been able to free up any of that capital because of the higher interest rates.
Ralph, Julian asked, are investors comfortable with IUL cap rates?
I don't think it's just real estate investors. I think we as insurance professionals are probably not always happy with the cap rates and how the companies change those. But you have to find a company that you feel is going to keep a reasonable cap rate. I also believe in this theory that what's happened with the S&P 500 is that the cap rates are all tied to the cost of S&P futures. And S&P futures, are just like anything else, are subject to supply and demand. There's a lot of money in this market that's chasing S&P 500 futures. Okay. There are lots of indexed annuities. There's a lot of indexed IUL. All of those are chasing S&P futures. You might be better off with a different index. Okay. The futures on like a Hang Seng or something else, the cost of the futures may be a little less, and you might get a better return. But again, if you're concerned about that, the way to do that is to allocate your account values into multiple indices accounts with the company. The only thing that I have against that is the S&P 500 is so easy to explain to a client. A lot of these others are not easily explained when you've got monthly cost average and spreads, and just say, hey, you're going to get what the S&P did over the last year, subject to a 10% cap.
Yeah.
Easy to explain, easy to understand. Hope that answered your question, Julian.
All right. Does anyone have any other questions? All right. Well, thank you, everyone. We appreciate you joining us today. I think this was a really good session, a lot of good information, and hopefully this will help you in discussions with your clients. So please let us know how we can help, and have a wonderful day. Thank you.
And also, by the way, before everybody goes, I'm available. If you want to chat with me directly, just give me a call and I'll be happy to go over this. I enjoy talking about this, so just let me know. Okay?
Thanks, everybody. Have a good day. Bye-bye.